You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Thursday. So we continue our quest to find great Canadian dividend-paying stocks that are not just exposed to the Canadian market, but exposed to the US, yes, but maybe even internationally. With the threat of tariffs and not knowing what's going to happen with our neighbors down south, maybe it's best to look for companies with a little bit more diversification. As you listened yesterday to part one of this quick two-part series, not that easy to find Canadian companies with a great exposure to the international market, and on top of that being solid dividend grower. So I continue this pursuit using the Rockstar list. So the Rockstar list is we screen over like 1,000 stocks, and then we look for companies showing a positive growth for revenue, earnings, and dividend for the past 5 years. So the thinking here is quite simple. If you're looking at a company that grows their sales, well, they're like gaining market shares, they have a good product, they are growing, so that's good news. And then if they are making more profits, so earnings per share is growing year over year, well, then it tells you that they don't just spend all their money to generate sales, but they're actually making profit out of those sales. So this is something that we like, right? So more revenue, more earnings, and then of course, if you have that great combo, you will likely have more dividend. So if you are afraid that the market is about to enter into a recession, your best protection is of course diversification, but also the quality of the stock that you invest in. And quality starts with metrics. It doesn't start with a great story. It doesn't start with an amazing business model and a wonderful investor presentation. It starts with numbers, because numbers don't lie that much. I say that much because, of course, you can say anything with numbers. But then again, if you have a combination of a company that is growing their sales, growing their profit, and growing their dividend, chances are you are looking at a good stock. So again, you can download the Rockstar list for free at moosemarkets.com/rockstars. It's being updated monthly through our free newsletter. So today we're going to look at 4 different sectors. The first one, industrials. And in the industrial sector is one of my favorite when I'm looking for a new addition for my portfolio, mostly because of its diversification. You could have like 5 different companies, and actually we're going to talk about like 5 different companies today in that sector that are not really related. That's the most amazing part. So you can go through this sector and then find multiple companies in different industries and still build a well-diversified portfolio. So the first one on my list is actually a great stock that I own, but I just wanted to highlight that sometimes we may think that it is exposed to the US market, but it's not really. And it is Toromont Industries. So it is one of the largest Caterpillar dealership, but most of its revenue is coming from from Canada. A very tiny part it's coming from the US, not enough to move the needle, and there's certainly not enough to say that it is a well-diversified company. Another stock that is quite similar to Toromont, though, it is Finning International. Unfortunately, it doesn't meet the dividend Rockstar list criteria, so you're not going to find it there, but it is quite diversified. So 52% of the revenue is coming from Canada, 35% from South America, and 13% from UK and Ireland. So 50-50 between home base in Canada and then international market. So interesting here to get this one in your portfolio, but just take a second look at the metrics just to make sure. Another one that is like almost half and half between Canada and the US, and this one you might want to take a second look at this one, but because it could be impacted by tariffs. Once again, we don't know what's going to happen, so don't go crazy about that. Personally, I don't do anything in my portfolio because you know what? Tariffs are not going to last for the next 50 years, and even if they would, companies would adapt. So Richelieu Hardware, RCH, 40% of their business is coming from the US and 60% from Canada. So if you're looking for something a little bit more half and half, that could be an interesting play. I love the fact that they're selling over like 100,000 of products throughout like a lot of retailers, such as like Lowe's, Home Depots, and the likes. So great company. Could offer a little bit more of dividend increases though, but yeah, that could be interesting. Waste Connection, a typical low yield, high growth stock. Actually, most of its revenue is coming from the US. Less than 15% is coming from Canada. So this one is interesting if you want to have a Canadian-based company. So you can buy it in Canadian dollar, but you get exposed a lot to the US market. Stentec is a recent addition about a year ago to my portfolio, engineering firm offering like support to their customers from A to Z. So from planning to building to managing to decommissioning. So really interesting business model. 25% from Canada, 53% from the US, and then another 22% from other part of the world. So again, an interesting play for diversification with a robust dividend triangle. The last one in the industrial sector, TFI International, about 1/3 from Canada, 2/3 from the US. Definitely cyclical business, highly tied to the economy. So an interesting mix in the industrial sector between Caterpillar dealership, Richelieu Hardware selling small parts for cabinets, for kitchen and bathroom, so for home renovation, Waste Connection, Stentec, an engineering firm, and then TFI International trucking company. You can see that we have it all in this one. Quick overview on the technology sector. We have open text, 53% US, 32% Europe, and Europe, Middle East, and Africa, and then only 4% from Canada. So this one is really a pure play from outside of Canada. Not my favorite right now. They grow by acquisition, but when there's no acquisition, organic growth is pretty pretty slow. So I wish I would see more growth coming from open text, but it used to be a great one. Another one that is not on the rockstar list but well diversified geographically is of course Constellation Software. I don't have the perfect breakdown, but they are buying so many different small niche software companies across the world. So if you want something that is not linked to the Canadian economy, Constellation Software could be on your list too. In the material sector, I could have selected a lot of those. Just decided to go with two that are in my portfolio. So CCL Industry, 43% North America, 29% Europe, 28% emerging markets. So almost 60% of their business is coming outside of North America. Could be quite interesting, especially because they have developed a lot of like great ties with different corporation in the food and healthcare business for packaging. Stella Jones, 70% of their sales are coming from the US, 30% from Canada. Since they're selling a lot of like niche products such as utility poles and railway ties, my guess is they're not going to be subject to much on tariffs, but again, that's just my personal guess. I'm gonna still hold all those shares for sure going forward. In the utility sector, we do have the classic Fortis. About 65% is coming from US and Caribbean, and then 35% Canada. So an interesting play on the power and on, of course, buying the second longest dividend grower streak with Fortis over 50 years. That is a testimonial of resilience going through all kind of market craziness and all kind of recession and still increasing their dividend. Two companies that are not part of the Rockstar list would be the Brookfields, so renewable and infrastructure. Both of them about 60% to 2/3 of their business in North America, and then about 17% in Europe. For renewable, we have like almost 20% in America and South America, and then 6% Asia. For infrastructure, it's like 15% Asia. So again, great diversification across the world for this one. There are probably a few REITs, a few material companies like Franco-Nevada that I did not cover, but I mean, there's so much I can do in 10 minutes, right? So that's why I think it's important that you do your due diligence, that you use the same methodology, filter by sector, select companies with a robust dividend triangle with the Rockstar list at moosemarkets.com/rockstars, and never forget to go into the financial statement to find out information. It takes a little bit more time, but it is important that you know what you own and why you own it. Some companies like Dollarama from yesterday's episode or Toromont Industries may let you think that they're like open to other geographic part of the world. It's not exactly what's happening, or not enough to move the needle. So you just have to consider this when you're about to make your purchase. All right, Moose, that's enough for today. Tomorrow, it's Retirement Friday. So we're going to talk about how you should plan your budget for retirement. So interesting topic here. So stay tuned and stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.